bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the January 23rd, 2024 podcast. This is the first 2024 episode of our Renewable Energy Tax Credit Finance series. This is a podcast series that we launched last year to help you stay current regarding renewable energy tax credit financing news, trends, and strategies. We're starting off the year strong today with a very hot topic in the renewable energy community, and that's the topic of transferability. So what is transferability? Transferability allows certain renewable energy tax credits to be transferred as separate property from the entity that the tax credit generated from to the tax credit or to a tax credit purchaser. And that tax credit purchaser in turn claims the tax credit on their tax return. Now, prior to the Inflation Reduction Act, only owners or lessees of eligible renewable energy property could claim tax credits. Congress created the transferability option under the Inflation Reduction Act back in August of 2022. Treasury released proposed guidance on transferability this past June of 2023. We're now seeing some of the first transactions to actually use transferability as part of monetizing renewable energy tax credits. And we have discussed transferability in previous episodes of the podcast, but that discussion was more of a technical, academic, a bit speculative level as to what we thought is possible and what was likely to occur. But now we're starting to see sponsors and investors using this option, which makes it a great time to look at structuring trends and recommended practices when it comes to transferability. Joining me in today's discussion, as those of you who are watching on YouTube can see, is one of Novogradac's leading renewable energy tax credit experts, my partner, Tony Grappone. We have a lot of information to cover today, so if you're ready, let's get started. Tony, welcome back to Tax Credit Tuesday.
Thanks, Mike. It's great to be back.
So Tony, before we get started, I want you to take a moment to introduce yourself to our audience and share some of the services you provide to our clients. I say that knowing that you're a frequent guest. So for many listeners, they've already heard you introduce yourself on prior Tax Credit Tuesday podcasts.
Great. Excellent. Thanks. So I'll keep it brief. Basically, in a nutshell, so I'm a partner with Novogradac & Company. I'm based in the Boston area. I've been with the firm since 2004. When it comes to services, I want the market to think of me when industry participants, if they need anything that's sort of accounting, tax, financial consulting related to renewable energy or other tax credit programs, I want them to think of me first. Okay. So whatever it is, accounting, again, audit, tax, financial modeling, consulting, reach out to me. I run a team of professionals that specialize in all those disciplines, and I'd be happy to help find you your service professionals.
So thank you for that. And now let's start off with a quick refresher, maybe level set our listeners as to what transferability is. So if you could give a high level, quick take summary of transferability.
Great, thanks. So transferability came out as part of the Inflation Reduction Act. And, prior to the Inflation Reduction Act, as you alluded to, if you wanted to claim or use a tax credit from a renewable energy facility, you had to be an owner or a lessee of the property. The Inflation Reduction Act increased access to those credits by allowing owners of those facilities to now sell or transfer those tax credits to someone that's not an owner of the facility or a lessee. Okay, so what that has done is it is provided what I like to call a significant increase in liquidity to those tax credits. And it helps give, bank investors, bank syndicators, private syndicators, the comfort that they need to know that they have a significant increase in financing options. It opens up a pool of investors to them that wasn't there previously. So they can work with their existing pool of investors, but now it also makes it easier for other types of tax credit users to enter the marketplace and benefit from these credits without having to be an owner or a lessee of these facilities. And so overall, it's increasing the liquidity of the renewable energy tax credits.
So that's a good way of framing it as the liquidity. It doesn't technically increase the ability of particular investors to use the credit. It just makes it easier for them to access the credit. And by increasing the access, you end up increasing the pool of companies that are choosing to invest.
That's
So
right.
during an episode that we did together last September, you had said that you expected to see more partnership flip transactions with this transferability option going forward. So how did actual Q4 2023 closings compare with your expectations?
Yeah, so it was a very active fourth quarter. And sort of as predicted, we definitely saw an increase in partnership flip transactions. Partnership flip transactions were always kind of the most common structure you saw in the marketplace, but they picked up even more momentum. And so the other structures that you can oftentimes see in renewable energy involve sale leaseback structures, as well as inverted lease structures. The inverted lease structures probably taken the biggest hit here out of those three structures because, as listeners may or may not know, under the inverted lease structure, you are not allowed to transfer the credit if you're using that inverted lease structure. Okay, so as a result, investors really value having that option to transfer the credit. And as a result, investors have basically looked at the partnership flip and said, look, we want to make sure we've got the option to transfer the credit should we not be able to use it. And so as a result, we want to pivot and we want to do more partnership flip transactions. So in the fourth quarter, we saw fewer inverted lease transactions close than we've seen in recent years, definitely more flips and flips with the option, partnership flip transactions where there's an option put into the partnership agreement indicating that they may elect to transfer the credits. We even saw a number of partnership agreements that were closed previously without a flip option. We saw a lot of partnership agreements get amended to add language to the partnership agreement, providing that type of flexibility.
So if we go back in time, a couple of years, as in the run up to the Inflation Reduction Act back in 2022, there was a lot of talk about, if transferability were to be enacted, how might it be adopted? What structures might be created? And then with the creation of the transferability option as part of the Inflation Reduction Act at our various conferences over the last year and a half, there's been lots of discussion of different structures that sponsors and investors were exploring. Which of those were being explored early on that you're now saying, this is not getting as much traction as initially, developers or syndicators might have been thinking they'd want to use?
Yeah, good question. So when the IRA was first passed and we learned that transferability was an option, I think a lot of people thought that this could actually do away with traditional tax equity. And you saw a lot of industry participants think, okay, we don't need a tax equity investor anymore. We can transfer the credit without having a partner in this deal. We can build the project and we could just go sell the credits. And while that option does exist, and you are seeing some of that for renewable energy facilities that are a certain size and type that would traditionally get third party tax equity, we're still seeing those get third party tax equity. And some of the main reasons why have to do with the fact that the traditional tax equity partnership helps you also monetize depreciation benefits. So if you're a developer and you work with that third party investor, unless you can use the depreciation benefits yourself as a developer, well, then those depreciation benefits really go unmonetized, or at least they're very inefficiently monetized, I should say. So that's one structure that people talked a lot about initially when the IRA was passed that they thought would just evolve into becoming the go-to structure that's just not used. Another reason why traditional tax equity partnerships are also still being used is, and this is a very important aspect of deal structuring. A lot of sponsors, when they place a facility in service, once the facility is stable, once their operations stabilize, it's not uncommon for a sponsor to want to monetize their sponsor interest in the transaction. And as a result, they may choose to sell their sponsor interest in the facility during the 5-year tax credit recapture period. Well, in a partnership flip transaction, the sponsor, oftentimes the most commonly used sort of flip arrangement is where the sponsor has a 1% pre-flipped interest and the tax equity partner obviously has the 99% pre-flipped interest. And so if you're the sponsor and you sell your interest during the recapture period when you only have a 1% interest, Well, now you're only subject to recapture on the 1% of the credits. That's a de minimis portion of the credits that usually allows the sponsor to move forward and monetize their sponsor interest. Well, if you're a sponsor and you just sell the credits and you don't have a third party tax equity investor in your transaction, that takes away your option to monetize your sponsor interest during the 5-year recapture period. That right there has proven to be extremely important in deal structuring in the post, IRA era, where sponsors are saying, yes, I want to monetize the depreciation, but another very important aspect to this is keeping that option open where I could potentially monetize my sponsor interest during the 5-year period. And so that's having that 99% pre-Class A member in your deal has real value to sponsors who typically like to sell their interest during the recapture period.
Great. Thank you for that. And mentioning the ability to monetize depreciation. It's not the purpose, not the discussion of the topic of this podcast, but there's also the refundability by certain tax exempts of the tax credit, and beyond the timing of the time by money reasons to maybe not want to go the refundability route. I assume you're also saying that that isn't being adopted as much because if you go down the refundability option by tax exempts of the credit, you don't get to monetize the depreciation expense either.
Same concept applies in with the deals that would otherwise be eligible for refundability or the elective pay option. Yep, that's right.
Now with Q4 2023 behind us, now looking into 2024, 2023 is behind us. What are some of the most common transferability structures that you're seeing now? Is it the same as what you saw Q4 2023 or are new structures being developed?
Yeah, so we're seeing some consensus building in the industry around favored structures. And it's not so simple as to just say, oh, it's the partnership flip. So you're seeing variations of the partnership flip in the way the terms and conditions with tax investors coming into the deal. Okay. So, for example, one option we're seeing is something that we saw a bit of back in the 1603 era, where you've got a partnership. It's a partnership flip transaction. And so you've got a 99, you got a 1%, pre-flip sponsor, you got the 99% pre-flip investor, but where the investor is coming in, putting their capital in what we call net of the credit. Okay. And so that's a scenario where the partnership's going to build the facility and the partnership's going to sell the tax credits and they're not going to distribute any of the sale proceeds to the Class A member. All of the proceeds in that situation might either get distributed 100% to the sponsor or used to pay off construction costs, okay, or a construction bridge loan. But basically, the partnership isn't raising part of their equity from the class equity investor to pay. They're raising less money from the class equity investor to pay off construction costs. Instead, the partnership is finding some other financing mechanism to pay for construction costs that used to come in part from their class equity, from their tax equity partner. Okay, and so that's a scenario where the class A tax equity partner is putting in money for depreciation benefits. Okay, and a portion of the partnership's cash flows, but not for the credits themselves. And that structure is called a T flip net of the credit. Okay. And so again, I'll take a step back here. Just in general, if you've got a partnership flip that has the option to sell the credits, that's being referred to in the marketplace as a T flip, a T flip. Okay. And so this first structure I just mentioned is like T flip, but net of the credit. Okay. The next type of T flip structure we're seeing is where you got a partnership flip. Again, same type of ownership mix, but where the partnership is going to sell most, but not 100% of the credits. The partnership is going to retain some of the credits. And one of the reasons we're seeing that is okay, some of the partners can use the credits. Some of the partners in the partnerships can and intend to use some of the credits. But also, part of the reason there is some buyers that are new to the renewable energy program do not want to they don't want to be exposed to potential disallowance of credits in the event the IRS comes in, audits the project, and potentially disagrees with eligible basis. And so the way the tax credit transfer rules work with respect to disallowance is if the IRS doesn't has a negative adjustment, let's say, to the eligible basis of the property, the disallowance is applied first to the retained credits, the non-sold credits. Okay, and so you're seeing some T flips where some credits are being retained by the partnership, either because the partners in the partnership can use the credits and tend to use them, or the buyer, not being totally familiar with the program, just doesn't want to fully underwrite all of the credits, and as a result, comes in and just offers to buy most, but not 100% of the credits. Okay. So that's the second most common T flip structure we're seeing. And then the third is sort of your classic T flip, where it's a partnership flip transaction with your 99-1 partners, and the Class A member contributes equity the way you normally would expect them to, but where the partnership sells 100% of the credits. Okay. And I should say, you are still seeing you're still seeing plenty of transactions out there where you've got an investor that has the option written into the partnership agreement to sell the credits, but it's really just there in the event that they have to. Okay. But they fully expect to use the credits. So that's a situation where the partnership flip looks like a very traditional structure that we've all been used to seeing even prior to the IRA.
So one thing that you mentioned when you're talking about the second option was if you transfer the tax credit, the buyer is on the hook for any recapture or any adjustment as to the amount of qualified basis if they were to buy 100% of the tax credit. And you mentioned that in some of these transactions, the partnership or the entity generating the tax credits, the rights to the tax credits, isn't selling 100% of the credit, and that they're basically allowing this cushion to exist so
Right.
that so that the buyer doesn't have to fully underwrite the entire cost. They just have to be confident that whatever percentage of the credit you're selling, you at least have costs of that level. And that can, ease any concerns they might have with respect to how much of tax credits they're buying. And then consequently, they don't have to rely quite as much on any guarantees from the seller as to the magnitude of the credits. Did I
Excellent.
summarize that reasonably well?
Yeah, you summarized that really well, but you also did me a favor, and you alluded to guarantees or basically sponsor indemnities. Okay, and you also helped jog my memory with respect to things like insurance. Okay,
Okay.
so if the partnership is retaining some of the credits, so not selling 100%, that could impact the amount of tax credit insurance a transaction takes on. Could also obviously reduce the sponsor indemnity a bit. Okay. So you are seeing a lot of, you're still seeing a lot of tax credit position insurance in the marketplace, on these transfer transactions as well. And so the retained credits impacts how those policies and indemnities are ultimately underwritten as well.
Now, I'm sure that the tax credit insurance, it's a lot easier to underwrite the insurance that's benefiting the buyer if there's some cushion partnership in terms of retained credits.
Right. Because some of these insurance providers have already underwritten the sponsor before in other transactions.
Right.
So could ease their underwriting a bit.
Now, Congress's goal in allowing transferability was to expand the ability of investors to more easily access renewable energy tax credits. It wasn't really expanding the market of potential investors. The ability to use the renewable energy tax credits is the same, with the exception of nonprofits, certain tax existing, they get a refund or they like to pay. But that being that aside, it generally didn't change, what types of taxpayers can claim the tax credit to offset their tax liability. But it did make it easier for a investor to access the credit by buying the credit as opposed to becoming a member of a partnership, being allocated the credits and so forth. And by making it easier for investors to access the tax credits, that would theoretically increase the demand for renewable energy tax credits. Many companies that can use the tax credits would now be more likely to enter the market for investing in these tax credits. And then, of course, that greater demand would lead to better tax credit pricing than if the transferability was not an option. So that's theoretically what led to this being enacted. Now the rubber's hitting the road. How are you seeing the transferability option actually affecting tax credit equity pricing?
Yeah. Yeah. I'll tell you, living through Q4, we definitely witnessed an increased demand for renewable energy tax credits. Okay. It's hard to say, in terms of top tier technologies, it's hard to say what that impact is quite yet because the reality is those top tier technologies were already spoken for before year end.
Right.
But deep into Q4, we saw transferees or buyers, okay, of tax credits reach out to us looking for tax credit opportunities to buy tax credits. That that gave some viability to some technologies and maybe some deals that in the past probably wouldn't have been able to raise tax equity. So we saw some technologies that are lesser traveled or maybe aren't totally in favor with certain types of investor pools. Those projects were able to monetize credits late in the year in ways that we haven't seen. And so I think that's a good sign that transferability is helping to lift the overall demand for renewable energy tax credits. And so I wouldn't be surprised, especially around quarter end when tax payments are due. I wouldn't be surprised if we continue to see elevated demand for renewable energy tax credits, especially as we get closer and closer to when estimated tax payments are due.
Right. Thank you for that. And I will just note for our listeners, you've heard me say this before. I think Tony's kind of confirming that clearly transferability created upward pressure on equity pricing for the renewable energy tax credits. And I like to say upward pressure because tax for equity markets, the net pricing, the cents per dollar quotes that often get used, there's a variety of factors that sort of play in there. And you could have upward pressure here and downward pressure from other conditions like rising interest rates and the rest. So when you're looking at it in terms of historical pricing versus current pricing, that doesn't really reflect the fact that this is creating upward pressure. It's more a question of what's the confluence of events and net, year in, year out, the pricing will vary. But as we start the year, Tony, heading into 2024, I wanted to ask you if there were particular reminders or tips that you think renewable energy tax credit investors, developers, and advisors should be aware of right now.
Sure. So I have two that I want to point out to our listeners. First and foremost, every year around year end, I like to remind people about deficit restoration obligations or DROs. DROs are a structuring option for partners and partnerships to preserve intended loss allocations. That's usually the most common use of why DROs are in place. And a situation that oftentimes gives rise to a DRO is where an investor may not have made an intended capital contribution before year end due to whatever reason they weren't able to. And so, and maybe that capital contribution was necessary to have their capital account at a certain level in order for them to get allocated a certain amount of losses from the transaction. If that capital contribution wasn't made before year end, it's possible the partners expected or intended to have a DRO to preserve that loss allocation. Okay. If that DRO hasn't been, memorialized quite yet, but that was the expectation of the partners, I just want to remind deal participants to, put some focus back on that DRO to make sure it's memorialized timely to preserve that loss allocation. So every year we see situations where DROs were expected, the parties talk about them, they plan on doing them, but they somehow don't get memorialized by year end amidst the flurry of events that happen around year end. So I just want to put that reminder out there to if you have a deal that placed in service towards year end and your investor contribution didn't come in as expected, revisit this concept of DRO with your investor and make sure it gets memorialized timely. The other reminder or heads up, if you will, I'd like to provide listeners with is on tax credit transfer transactions. If you sold or if you're a party to a tax credit transfer agreement in 2023, this is a heads up with respect to state taxation. As most people know, tax credit transfer proceeds are tax exempt federally, but not all states conform to that tax exempt treatment. And so you want to reach out to your tax advisor. And if you haven't already, if you don't know how your state treats these tax transfer proceeds, reach out to your tax advisor to figure out if they're subject to taxation or not.
And I just would note that when you think about this question of the taxability at the state level. You have to be thinking about the state in which the property is located. You have to
Exactly.
be thinking about the state where the taxpayer is located. And you have to think about the state where, the business, if there's a developer and the rest, and they're operating in a different state, you have to be thinking about the state that the developer is sort of operating in. And there's probably one or two other states that I didn't mention or situations of other states you have to be aware of. So it's not as simple as simply looking at the state where the property is located, or as simple as looking at the state where the investor is. And I'll leave it at that. And maybe we'll have a future podcast on state taxation issues related to community development and renewable energy. So Tony, thank you for being a guest on Tax Credit Tuesday. Please do stick around for our off mic section. And our regular listeners know I usually ask my guests for some fun off-topic advice or words of wisdom. And you've been on before, I've done that. But this time, our off mic section is going to have a bit of a twist. So obviously, I know you're going to stay tuned, Tony, but I'll invite our listeners to stay tuned as well. And to our listeners, I will share Tony's contact information in today's show notes. So you can contact him directly with any questions or for assistance with your renewable energy projects or investments. I'll also include in our show notes the links to previous episodes in our renewable energy tax credit finance series, so you can catch up on any episodes you may have missed. We also have a dedicated playlist on our YouTube channel with all of our episodes in this series. So please be sure to check that out. And I'd also encourage you, in the coming months, we'll have our next renewable energy tax credit conference. So I encourage you to join us there as well. And now we've reached our off mic section. And as I noted earlier, normally this is when I ask my guests some fun off-topic tips and recommendations for our listeners. But this week, we're going to take a different approach. Tony, I want you to share an industry shout out, someone who's done a lot for the renewable energy community over the years that you sort of respect and work with a lot. So please, the floor is yours, Tony. Please share an industry shout out.
Awesome. Thanks, Mike. Yeah. So, I've been working in the renewable energy industry since the early 2000s, and I've had the pleasure of working with a lot of just fantastic, talented people over the years. And so I appreciate having the opportunity to give a shout out to some folks here. So I'll start this week. I'll give a shout out to somebody that I started working with from the very beginning. It's a partner with Nixon Peabody, a friend and a colleague, Jim Duffy. And so Jim was one of the first professionals I met in renewable energy. And at first we had a similar goal of just trying to get out there and market our expertise. And so it started where we just happened to be speaking at the same renewable energy conferences and events. And we forged a bit of a friendship through that sort of marketing activity. But that ultimately led to us working on the same deals together, and just a lot of knowledge sharing, batting ideas around on how to best structure transactions and help our clients, structure deals successfully by maximizing the value of the incentives, but also at the same time complying with all the various rules and regulations. And so, we started working in the industry. Back then, there weren't a lot of deals getting done. There weren't even a lot of people in the industry. And it's been great to kind of work with him throughout all these years and see the industry grow to where it's come today. So shout out to Jim Duffy of Nixon Peabody.
Great. It's a great shout out. I've really enjoyed working with Jim over the years as well. But I do have to ask you, have you been to a Boston Bruins game with Jim?
I've been to many Boston Bruins games with Jim Duffy.
You have.
Yeah, I could send some photos, some selfies of Jim and I at the Garden. Okay.
At the Garden. Okay. So I'm gonna call you on that. So
all right,
you share some photos with me, and I'll tweet them out.
Cool. I'll do that.
Okay.
Yep. Great.
Thank you, Tony.
Thanks,
to our listeners. I'm Mike Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac & Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac & Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novaco.com.